According to supply managers in the 9 Mid-America states, how is the economy performing?
Our survey here at Creighton University, survey of manufacturers, supply managers in manufacturing for the 9 Mid-American states stretching from North Dakota and Minnesota and north to Oklahoma and Arkansas in the south. The overall reading was up slightly. Now it's up to 50.9, and that's from December's 50.3. And that's, I won't say that's great news, it's better news than I was expecting. The national number will come out later on this week, or later on this morning, in fact. And I expect that number to likewise be up, but not as strong as our number here at Creighton University. Only 9.1% of the manufacturing supply managers expect the economy to expand in the next 6 months. So that was the negative part of it. When they said today they're expanding a bit, not much, and they expect to not only 9.1%, or almost 1 out of 10, expect the economy to expand in the next 6 months. And we ask about the greatest threat to their businesses, and 22% said recession. Now that's pretty much expected. 21% see finding and hiring workers is still an issue. That's finding and hiring qualified workers is the second greatest threat to their business going forward. 17.4% said higher input prices was the greatest threat. 4.4, and that's a small percentage, said tariff and trade wars. That's usually not very high, and it wasn't very high this time. And of course, that leaves 35.2%, which are other factors, not so much any one factor going forward. Now I'll bring up the chart comparing the U.S. PMI, Purchasing Management Index, to our Creighton Purchasing Management Index. There you see the Creighton number is in blue, and that's 50.9, as I said. And last month's PMI, the U.S. PMI, was 47.4. As I said, later on this morning, the U.S. number will come out. I expect it to be a bit higher, but it'll probably still be below growth neutral.
What were the hiring trends?
Hiring was not good this month. The hiring index was 39.1, or well below growth neutral, from December's 50.0. And 26.1% of the supply managers reported job losses for the month. 43.5 reported a shortage of job applicants, so there's some mixed messages in there. 13% said they were not hiring due to the economic slowdown. So all in all, it's showing that the labor market's still tighter than I would have expected. When you look at the job losses, or job gains, I should say, according to the region, season adjusted over the last 12 months, 1.3% growth there. That compares to a higher U.S. number of 1.7%. When you turn to manufacturing, though, the region has lost manufacturing jobs this year over the last 12 months, for 2023, lost about 800 jobs, and that's not many. That's, in fact, 1/10 of 1%. When you look at U.S. manufacturing jobs for the same period of time, they only added 12,000 jobs. Again, that's a gain of 1/10 of 1%. So when you look at the manufacturing sector for 2023, not a good year. You could, in fact, say that the manufacturing sector was in a recession for the region and for the nation.
What inflation trends are you noticing?
Inflation higher than we would have liked to have seen. This, of course, is the wholesale inflation gauge. It was up to 71.7, and that's up from December's 57.7. So that's a bit higher than we'd like to see. I still think we have some inflationary battles to fight. The Federal Reserve does, for sure. But keep an eye on that month to month rather than year over year CPI changes and the PPI changes. When you look at the CPI for the 3 months, last 3 months, it was 0.4 of 1%. The core was 0.8 of 1%. That's higher than you'd like to see. The 0.8 of 1%. That is above the target for the Federal Reserve. When you look at the PPI, the Producer Price Index, or the Wholesale Price Index, it actually declined over the last 6 months, and that's the overall one. When you look at services, though, it was flat. No growth at all over the last 3 months. So what we're seeing is a lot of disinflation but not deflation. In other words, inflation's coming down, but you're still seeing higher prices out there, and that's what consumers are reacting to. That's what our supply managers are reacting to. And inflation still remains slightly above the Fed's target. Now, this is over the last 3 months, and of course the Federal Reserve is meeting this week, and they're dealing with that very issue going forward.
What is the economic outlook?
I expect some real problems going forward for 2024, particularly in real estate. Not so much in manufacturing, as our surveys are showing it's okay, moving up, slightly up, and a bit sideways. But in real estate, no. Residential real estate, I expect some problems there. House prices have got to come down. Commercial real estate, likewise, we've got too much refinancing going on in the commercial real estate. We'll see some problems there. So keep an eye on real estate in the first quarter and the second quarter of this year and see how that plays out. But that could be the first inkling of an economic downturn. I expect no rate changes, and of course that's what we got just yesterday. The Federal Reserve announced no rate hikes, and that was expected. No one was surprised with that. I expect the Federal Reserve to cut rates in March of this year. In their March meeting, I think there will be a rate cut of 25 basis points or 1/4%. And that's good news and bad news. The good news is rates are coming down. The bad news is, why are they coming down? They're coming down because the economy is slowing down. They're coming down because inflation is coming down as well. Keep an eye on the Federal Reserve's balance sheet. Very important. And they've indicated they may pull back on some of their quantitative tightening, and that's a good thing. But the question is, why are they doing that? And I think the reason they're doing it is they see more weakness, just as I do, just as a lot of economists do. And the CPI month over month, we're probably talking about when the January number comes out in February. I think that's going to be about 0.3%. That's still above the Fed's target, still a bit too strong. So again, I do think, though, when they meet again in March, I still think there will be a rate cut at that meeting. Long-term rates will move sideways, meaning I don't see much growth there. We could see a little up, a little down, but mostly sideways on long-term. The prime interest rate will remain where it is right now at 8.5% until the Fed cuts rates, and they'll cut rates in March. I think that'll be the first rate cut in this regime. Now again, the Fed's penciling in 3 rate cuts this year. Investors are penciling in 7 rate cuts, or 6 to 7. That's not going to happen unless, of course, there's a significant economic downturn. Keep an eye on the bond market. The bond market is always telling you more than the stock market. The stock market's been up, but that's mostly the Magnificent Seven. Most stocks have been moving up a bit, but mostly sideways. But the yield in the 10-year Treasury, keep it when it bounces between 3.7, say, and 4.5%. That's in a range that we're okay. Moves above 4.5, there's some real issues with inflation. Moving below 3.7, 3.6, there are real issues with a recession. Keep an eye on the Federal Reserve's balance sheet. And you can go to Google and just say Federal Reserve balance sheet, and it'll take you right to it. They're reducing the balance sheet they were at $95 billion a month. They pull back on that. They're not doing that now. And see how much they are reducing it by month. If they cut off quantitative easing, be careful. There's a reason they're doing that, and the reason might be that the economy is slowing down too much for the Federal Reserve. Keep an eye on the national ISM reading, which comes out, as I said, later on this morning. That reading, I still expect it to be below growth neutral, but it's going to be up from last month. That's December's reading, of course. Price of a barrel of oil, that could be very important. That's been teetering around $70 to $75 a barrel. Should it move below 70. That may be another indicator of a slowing economy. If it moves up in the upper 70s to potentially to 80, that's indicating too much inflationary pressures. That could take the Federal Reserve out of cutting rates and just holding on rates. I do not expect a rate hike this year. I do expect rate cuts, but not many. Listen to carefully what the Federal Reserve members of the Open Market Committee state. That's the 7 governors and the 5 presidents of the banks, the Federal Reserve banks across the U.S. They sit on the Open Market Committee. They determine interest rate policy, whether it's short-term interest rates, that's the funds rate, which is linked to the prime or the prime's linked to it, and also the balance sheet. Those are the 2 you want to keep an eye on. So that's it for the month of January here at Creighton University. I'm Ernie Goss, and until we meet again on the first business day of March, may your economic cup runneth over, and thank you much.